Ever wondered how something that isn't a human can own property, enter contracts, and yet, surprisingly, can't marry or vote? Welcome to the fascinating, often surprising, and sometimes complex world of company law. Today, we're taking a deep dive into the foundational concepts and intricate workings of company law. We'll be drawing from a comprehensive set of legal insights and practices, largely anchored in the principles applied in a major common law jurisdiction like India. Think of it as your essential guide to understanding the very backbone of how businesses operate legally, seen through, well, a very specific but illuminating lens.
Absolutely. And our mission for you today is to demystify these legal structures. We'll journey from the fundamental idea of a company's separate identity all the way to the detailed rules governing shares, meetings, and even things like corporate social responsibility. We'll try to extract the most important nuggets, connect the dots for you, and ensure you walk away well-informed without feeling, too overwhelmed by all the technical jargon.
Exactly. We're going to unpack how companies are born, what their core documents truly mean, how they raise capital, the rights and responsibilities of everyone involved, and even the mechanisms for oversight and transformation. Get ready for some aha moments and maybe some surprising facts about these artificial juridical persons that drive so much of our economy.
The company's identity more than just a name.
Okay, let's kick things off with, I guess, the most fundamental truth about companies.
Yeah.
They aren't human, yet the law treats them almost like one. It's what we call an artificial juridical person. What does that really mean in practice?
Well, what's fascinating here is that this legal construct, it's created purely by law, and it's essentially clothed with rights, obligations, powers, and duties, very much like a natural person. So it can own property, it can enter into contracts, it can sue people, and importantly, it can be sued itself. But of course, as you said, there are clear limits. A company can't marry or divorce, it can't vote in an election, and it certainly won't develop personal preferences like a favorite coffee shop. This distinction is absolutely fundamental to understanding how these entities exist and operate.
And perhaps the most crucial concept tied to this artificial person is its separate legal entity status. On incorporation, a company becomes distinct, totally independent from its members, its owners. It's not just a group of people. It genuinely has its own corporate existence, which is a real game changer compared to, say, a partnership, which usually doesn't have that separate existence from its partners.
Exactly. And this concept, it was famously established way back in 1897 in the case of Salomon v. Salomon & Co., Ltd. If you picture Mr. Salomon, he was a boot manufacturer. He turned his successful sole proprietorship into a company. He, his wife, his kids, they were the only shareholders. He even lent money of the company secured by a charge. Now, later, the company got into financial trouble, it faced insolvency, and the other creditors argued, hey, Mr. Salomon and the company, they're basically the same thing. He shouldn't get his loan repaid before us. But the court, very firmly, ruled that once a company is validly formed, it becomes a distinct legal person, period. It doesn't matter if one person effectively controls everything or how many shares someone holds. The company owns its assets and is bound by its liabilities, not its members.
So even if I own like 99% of a company, the company's fancy office building isn't my building, and its big loan isn't my loan. That's a really powerful separation.
It truly is. And this separation, it also has really significant implications for how income is treated. Take the case of Mrs. Batya F. Guzdar, the Commissioner of Income Tax, Bombay. You had a tea company, and it earned income that was partly tax-exempt agricultural income. But when that income was distributed to a shareholder, Mrs. Guzdar, as a dividend, the court ruled it was no longer considered agricultural income for her personal tax assessment.
Oh, interesting. Why not?
Because the company, as that separate legal entity, was the one that earned the income. The dividend she received was just a share of the company's profits. It wasn't the original agricultural income itself. The court was very emphatic. It refused to blur the lines between the shareholders and the company. It reinforced that a shareholder holds rights in the company, but isn't a direct owner of its underlying property.
That makes perfect sense. Okay, so this artificial person, it needs a kind of birth certificate and maybe a rule book, right? That brings us to the foundational document.
Absolutely. These are often called the charter documents of a company. First up, you have the Memorandum of Association, often just called the MOA. You can think of it as the company's constitution. It sets out its name, its registered office address, its core objectives, so what it was actually created to do, its capital structure, and the liability of its members. It essentially defines the company's identity and its relationship with the outside world. It's the very purpose and the limits of the company, pretty much etched in stone.
So it's like the company's mission statement, but it's legally binding.
Precisely. And this leads straight to a critical legal principle. even if every single shareholder were to agree to it afterwards. The A. Lakshmanaswamy Madalyar VLIC case is a really good example here. A company made payments to a trust for promoting technical knowledge, but this was after the company had actually stopped its main business operations. The court deemed these payments ultra vires. They were outside the company's stated objects and therefore legally invalid. It just shows how strictly the law tries to ensure a company operates within its declared purpose.
Wow, that sounds incredibly restrictive, though. What if the company just do something really practical, but it's not spelled out word for word in its MOA? Like, buying office supplies or hiring a receptionist. Surely that's allowed.
That's a great point, and the law does account for that, absolutely. While the stated objects are specific, companies possess what are called implied powers. These are powers that are necessary or, incidental to actually conducting the stated business. So, for example, a trading company implicitly has the power to appoint agents or borrow money for its trading purposes, like in the Oakbank Wilco v. Crum case. These aren't explicitly written down, maybe, but they're considered natural and consequential to carrying out the main business. So yes, the company can definitely buy pens and hire people. No problem there.
Okay, good to know. And then once you have that big picture constitution, the MOA,
Yeah.
you need the nitty-gritty rules for how the company actually runs day to day, right? That's where the Articles of Association come in.
Yes, exactly. The Articles of Association, or AOA, are essentially the company's internal rulebook, its bylaws. They govern the management of the company and its internal affairs. They dictate things like how decisions are made, how shares get transferred, how meetings are conducted, who can do what.
So the MOA says what the company is, and the AOA says how it works internally.
That's a perfect way to put it. And the AOA, it must always be consistent with the MOA and also with the overarching Companies Act, the main law governing companies. They form a binding contract between the company and its members, and interestingly, also between the members themselves, regulating their mutual rights. Though, generally speaking, it's the company itself that has the standing to sue to enforce these internal rules directly.
Now here's something I find interesting, kind of balancing act. On one hand, the law says outsiders dealing with a company are sort of assumed to know its public documents, like the MOA and AOA that's constructive notice, right, protects the company. But then there's this other doctrine that seems to swing the other way to protect outsiders. The doctrine of indoor management. How does that work?
This is where it gets really interesting, and it's a great example of the law trying to be fair in commercial dealings. While constructive notice is like saying, hey, these documents are public, you could have checked them. The doctrine of indoor management steps in and says, but hold on. We can't realistically expect outsiders to know if a company's internal procedures have been perfectly followed for every single transaction. So if an outsider deals with a company in good faith, they can generally presume that all the internal procedural requirements have been met.
So it's about protecting the innocent party, the good guys, who didn't know about some internal paperwork glitch.
Precisely. Take the example of, let's say, Planet Limited v. Earth Limited. Imagine Planet Limited gets a check from Earth Limited, signed by its directors and secretary. Seems normal. Later, it turns out those individuals were maybe improperly appointed according to Earth Limited's own internal rules, their articles. Planet Limited could still sue Earth Limited on that check because they could presume, acting in good faith, that Earth Limited had sorted out its internal appointments correctly. This doctrine protects good faith third parties from the impossible burden of investigating a company's complex internal workings every time they deal with them. But, and this is important, it does have limits. It doesn't apply if an agent is clearly acting way beyond their apparent authority, like an accountant trying to sell the company's building, as in the Anand Bahari Lal v. Dinshaw & Co. case. That's just obviously wrong. Nor does it apply to situations where the very existence of the agency relationship is in question, like in Varki Soriar v. Kerala Bank & Co., LTD. So it's about internal procedural irregularities, not a fundamental lack of power or authority.
Okay, that distinction is really key. Now, circling back to that separate legal entity concept, it's a privilege, you said. What happens when people try to abuse that privilege?
You've hit on a crucial point there. The separate personality, it is a powerful privilege granted by law. But when it's used fraudulently, dishonestly, or maybe to deliberately evade legal obligations, courts have the power to lift or pierce the corporate veil. This means they look behind the company's separate legal identity to hold the individuals controlling it directly liable. It's a vital safeguard against the abuse of the corporate structure.
And we saw this potentially play out in a very high-profile way with the Vodafone International Holdings BV Union of India case, didn't we? Can you walk us through the basics of that one?
Certainly. Yeah, that was a landmark case really tested the limits of piercing the corporate veil in India. The core issue was whether an offshore transaction where one foreign company bought shares in another foreign company should trigger Indian withholding tax. Why? Because the ultimate result was that control of a major Indian mobile business changed hands. The Indian tax authorities argued that the whole complex structure was basically designed to avoid Indian taxes. They essentially asked the court to pierce the veil of those offshore entities and treat the transaction as if it happened directly in India, making it taxable there.
Right, so they wanted to ignore the separate companies involved and look at the economic reality, the beneficial ownership changing hands.
Precisely, that was the argument. However, the Supreme Court, after a lot of deliberation, ultimately set aside the tax demand. They emphasized that the corporate veil should only be pierced in, well, exceptional circumstances, like clear cases of outright fraud or tax evasion with demonstrable dishonest intent or malified intent. In this specific case, they found the arrangement, while definitely complex, was part of a legitimate business acquisition structure. It wasn't considered merely a sham set up just to avoid taxes. So the ruling really underscored the sanctity of the separate legal entity principle and the very high bar courts set for disregarding it, even when huge amounts of money are involved. It highlighted that careful balance courts have to strike between protecting the corporate structure and preventing its abuse.
Company types in modern administration.
Okay, so we've established that a company is this distinct legal person. But not all companies are the same, are they? They seem to come in different forms, almost like different flavors to suit various business needs.
That's absolutely right. The law categorizes companies to provide frameworks that make sense for different scales and types of businesses. You've got private companies, which typically restrict the transfer of their shares. You can't just sell them freely. They also limit the number of members, usually to 200, and you only need a minimum of 2 people to form one. Then on the other end, you have public companies. Their shares are freely transferable on the stock market usually. There's no upper limit on the number of members they can have, and you need at least 7 members to get one started. And for the solo entrepreneur, the Companies Act even introduced the one-person company, OPC, which is quite innovative. Plus, there are distinctions based on liability. Most common is limited by shares, where a member's liability is capped at the unpaid value of their shares. Or you can have one limited by guarantee, where members agree to contribute a set amount if the company winds up, often used for nonprofits.
And I understand there are also specific categories like small companies. What's the thinking behind classifying some companies as small?
Yeah, the Companies Act 2013 specifically created thresholds to define small companies. It's about simplifying compliance for genuinely smaller businesses. For instance, the thresholds for paid-up capital, currently up to Rs 4 crore, and turnover up to Rs 40 crore, define who qualifies. The main benefit here is really about the ease of doing business. These small companies get certain exemptions from some of the more complex compliance requirements. Things like rotational rules for directors, stricter board meeting procedures, maybe less detailed annual reporting. It's designed to reduce the administrative and financial burden, letting them focus on growing their business without getting bogged down at the same level of regulation as a massive corporation.
That makes perfect sense. Less red tape for the little guys, basically.
Exactly. But it's important to note, holding companies and subsidiary companies are explicitly excluded from the small company definition, even if they technically meet the financial criteria. This is clearly to prevent large corporate groups from somehow exploiting these benefits meant for genuinely independent smaller businesses.
Ah, okay. Closes a potential loophole.
Precisely. And then we also have government companies. These are companies where the government, central or state, or a combination holds a significant stake, typically 51% or more of the paid-up share capital. They have some unique exemptions from certain provisions of the Act. For instance, they might be allowed to use state in their name. Rules about share transfers don't necessarily apply to government nominees, and they might have specific requirements for setting up committees. And importantly, the Comptroller and Auditor General of India, CNAG, plays a crucial direct role. The CNAG appoints the auditors for government companies and dictates how the audit should be conducted. This ensures a very high level of public accountability for these entities, given that they are publicly owned.
Right, so the government gets some special treatment, but also faces special oversight. Interesting balance. Now, one of the real sort of superpowers of a company that really distinguishes it from an individual is its perpetual succession. Can you explain that a bit more?
Absolutely. Perpetual succession is a fantastic term. It means the company continues to exist in the eyes of the law indefinitely, regardless of what happens to its members. Shareholders might die, they might become insolvent, go bankrupt, but the company's life just keeps going. its existence is perpetual. It's a fundamental characteristic that provides incredible stability and continuity for business operations. Unlike, say, a sole proprietorship or a partnership, which might legally dissolve if a key person dies or leaves, a company's existence isn't tied to the lifespan or solvency of any single owner or manager.
So the company can essentially outlive generations of its owners and managers. That allows for incredible long-term vision, doesn't it?
Indeed it does. It's a major reason why the company structure is the preferred vehicle for large, long-term projects and investments. Now, speaking of how these enduring entities actually function in the modern world, the administration of company law itself has really had to embrace the digital revolution.
Yes, I've heard about the MCA 21 project. It sounds like a really big step towards modernization for corporate affairs.
It truly is. The Ministry of Corporate Affairs, MCA, initiated the MCA 21 project. It's a flagship e-governance initiative. Its core purpose is to enable easy, secure, online filing of documents and delivery of services related to corporate governance. The project aims to bring what they call smart governance, simple, moral, accountable, responsive, and transparent to the corporate sector. It significantly simplifies critical processes like incorporating a new company, getting director identification numbers, DINs, registering charges on assets, filing annual returns, and it even allows users like you or me to view public company documents online and raise complaints electronically. These aren't just scanned PDFs of old paper forms, they are re-engineered electronic forms, constantly updated for technical changes and new legal requirements. It really makes corporate compliance much more efficient for businesses and far more transparent for the public. It's like the digital backbone for corporate India now.
Capital, members, and their dynamics.
Okay, so a company needs that legal identity, and it needs systems to manage its affairs, digitally even. But to actually operate, to do anything, it needs money. Cold, hard cash. This brings us to the crucial concept of share capital. It sounds straightforward, but there are actually different types, aren't there?
You're absolutely right. Understanding share capital is fundamental to grasping how a company is financed. We talk about several different types, and the distinctions matter. First, there's authorized capital. That's the maximum amount of share capital a company is legally permitted to issue, as stated right there in its memorandum of association. It's like the company's potential funding ceiling from shares. Then you have issued capital. These are the shares the company has actually offered and allotted to investors, taken out of that authorized pool. Next is subscribed capital. This is the portion of the issued capital that investors have actually agreed to take up. They've subscribed for them. Then there's called up capital. This is the amount the company has formally asked the shareholders to pay on those subscribed shares. They might not ask for it all at once. And finally, maybe most importantly from a cash perspective, there's paid up share capital. This is the money the company has actually received from investors for the shares they subscribe to.
Okay, so if I buy shares and the company only asks for, say, half the payment up front, the rest is uncalled capital until they call it out.
Exactly. That's precisely how it works. And the money that eventually flows back to shareholders, typically from the company's profits, that's called a dividend. A dividend is a return in the investment you made in the share capital. It's distinct from interest, which is paid on borrowed money, on debt. A dividend is essentially a share of the profits distributed among the members. Understanding these different categories of capital is really crucial because they determine a company's financial flexibility, how it's valued, and how it raises and manages funds.
Right, got it. Now, how does a company actually go about getting that money from investors in the first place? There seem to be different ways to issue these shares.
Yes, companies can issue securities, primarily shares, through various means. The most well-known way is probably a public offer. This usually involves publishing a detailed document called prospectus, inviting the general public to subscribe to the shares, often leading to a stock market listing. Then there's something called a private placement. This is a much more restricted and targeted offer, not made to the public at large. And finally, companies can raise more capital from their existing shareholders through rights issues, where current shareholders get the first option to buy new shares, usually at a favorable price, or through bonus issues, which are essentially free shares given to existing shareholders, capitalized out of the company's accumulated profits or reserves.
Let's zoom in on that private placement for a second. It sounds like it's not for just anyone off the street.
You're right. A private placement is specifically a restricted offer or invitation to subscribe to securities. It's made only to a select group of identified persons, not to the general public. The law is very strict here. There's a prohibition on public advertisements or using general marketing channels for these kinds of issues. You won't see billboards for a private placement. To ensure transparency and prevent abuse, doing a private placement usually requires a special resolution from the existing shareholders for each offer. Plus, there have to be specific disclosures in the explanatory statement that goes with the shareholder notice, things like the price justification, who valued it, and what the funds will be used for. And companies must file a return of allotment with the Register of Companies pretty quickly, within 15 days of actually allotting the shares.
Okay. And I've heard that companies generally can't just issue shares at a discount, like below their face value. Why is that restriction in place?
That's generally true, yes. Issuing shares at a discount, meaning selling them for less than their nominal or par value, is prohibited by the Companies Act and any such issue. This rule is primarily there to protect the integrity of the company's capital, to prevent potential market manipulation, and to ensure fair treatment of all investors, both existing and new. It basically ensures that shares are valued appropriately and that the company receives proper consideration, proper value for the capital it's raising. Now, there are very narrow exceptions, things like sweat equity shares, which are issued to directors or employees when providing know-how or intellectual property rights, or sometimes shares issued when converting debt into equity as part of a formal statutory resolution plan, like a debt restructuring scheme approved by authorities. But outside those specific exceptions, if a company tries to issue shares at a discount, it can face serious consequences, penalties, having to refund the money with interest, and hefty fines. It's a compliance point regulators take very seriously.
Okay, so we've talked a lot about shares. Now, who are the people who actually own these shares, and is there a difference between a member and a shareholder? It sounds like people might use those terms interchangeably in everyday conversation.
They often are used interchangeably, and usually it doesn't cause much confusion. But in strict company law terms, there are subtle distinctions. A person typically becomes a member of a company in one of three main ways. One, by subscribing to the Memorandum of Association right at the beginning when the company is first incorporated. They are the initial members. Two, by agreeing in writing later on to become a member, and crucially, having their name officially entered in the company's Register of Members. Or three, which is very common today, by holding shares as the beneficial owner in a depository system, like through a demat account with a broker. So while almost all shareholders are members, it's technically possible, especially with depository systems, for a person to be the beneficial owner, the real shareholder, without being the registered member on the company's books. In that case, the depository itself is the registered member, but the law increasingly focuses on the ultimate beneficial owner.
And to keep track of all these owners, registered or beneficial, companies need a formal record, right? Official list.
Absolutely. The Register of Members is a mandatory legal record that every single company must maintain. And that includes details even for beneficial owners whose shares are held electronically in a depository system. Transparency of ownership is key. If a company has members residing outside the country, say India, it's also allowed to maintain a foreign register for those members in that specific country. But importantly, a duplicate copy of that foreign register must always be kept at the company's main registered office back in India, and the entries need to be promptly transferred to the main register. This just ensures all member records are centrally accessible for regulatory checks, potential inspections, and public viewing where permitted.
Right. And speaking of transparency and who really owns things, there's this critical concept called significant beneficial owners, SBO. What's that all about? It sounds like the law is trying to figure out who the real person pulling the strings is, even if they're hidden.
You're spot on. This is a really critical concept in modern corporate transparency, specifically designed to peel back layers of complex corporate structures, like chains of companies or trusts. The law requires individuals to make declarations about their beneficial interest, especially if they qualify as a significant beneficial owner. An SBO is defined broadly as an individual who ultimately holds a beneficial interest of at least 10% in a company, whether through shares, voting rights, or control, but crucially, whose name is not entered in the company's register of members as the holder of those shares.
So it's targeting indirect ownership, the person behind the curtain, maybe hiding behind another company or a trust structure.
Precisely. That's exactly the target. This provision aims to identify the real individuals, the natural persons, who ultimately control or significantly influence a company, even if their ownership is indirect. It's a powerful tool to combat things like anonymous control, potential money laundering, benami transactions, and generally ensure accountability. Companies have a duty to identify their SBOs, make a note of their declarations in the Register of Members, and file a specific return detailing this information with the Register of Companies. And for the SBOs themselves, failure to make the required declaration can lead to quite significant penalties, including fines and potentially even the loss of their rights associated with those shares, like voting rights or the right to receive dividends. It really underscores how seriously regulators view this transparency requirement in modern corporate governance.
Well, it's a pretty serious incentive to be transparent about who really owns what. Now, once you are properly identified as a member, what rights and, I suppose, liabilities do you actually have?
Okay, once you're officially a member, you gain a bundle of important rights. The most fundamental ones usually include the right to attend general meetings of the company and the right to vote at those meetings. This is the primary way members exercise their influence over the company's direction, including electing directors and approving major corporate actions. Members also typically have preemptive rights when the company issues further shares. This is often called a right issue. It means that when a company decides to issue new equity shares, it must first offer those shares to its existing equity shareholders in proportion to their current holdings. This protects their proportional ownership stake from being diluted without their having a chance to participate, unless the company's articles specifically state otherwise, or the shareholders vote to waive this right.
What about the flip side, liability? Does buying a share mean you're suddenly on the hook if the company racks up huge debts?
Liability. That really depends crucially on the type of company. For companies limited by shares, which is by far the most common type for businesses, a member's liability is strictly limited. It's capped at the nominal value of the shares they hold, specifically the amount that remains unpaid on those shares. So if your share has a face value of Rs 100 and you've already paid Rs 60, your maximum potential liability is only the remaining Rs 40 per share, no matter how much debt the company accumulates.
Okay.
For companies limited by guarantee, which you often see for nonprofits or clubs, a member's liability is a predetermined sum they agree to contribute only if the company is wound up and needs funds to pay its debts. And then, in the very rare case of unlimited companies, the members are indeed fully and personally liable for all the company's debts, just like partners in a partnership. But these are very uncommon for regular businesses precisely because of that unlimited risk.
That limited liability for share companies is definitely one of the biggest draws of using a company structure, isn't it? It really protects the personal assets of investors. Now, what if I want to sell my shares? Or what happens if shares need to be transferred because, sadly, someone passes away?
Right, transfer and transmission. Shares are considered movable property, like your car or furniture, and so generally they are transferable. However, for private companies, their articles of association almost always include restrictions on this right to transfer shares. A common restriction is a right of preemption clause. This means if a member wants to sell, they might have to offer the shares first to the existing members or perhaps even to the company itself before they can sell them to an outsider. This helps the original owners maintain control and keep the company private.
And for public companies, the ones listed on stock exchanges, for example, is it just a free-for-all then?
For public companies, the law explicitly states that their shares are freely transferable. That's a defining characteristic. Directors of a public company typically have very limited discretion, if any, to refuse to register a transfer, ensuring liquidity for investors in the market. When shares are transferred, there's usually a stamp duty payable on the transfer deed, the legal document effectuating the transfer. Importantly, the share certificate itself, or the electronic record in a DMAT account, is considered prima facie evidence of title. That means, on the face of it, it proves ownership. This binds the company through a legal principle called estoppel. Basically, the company can't later deny the facts stated on that certificate if someone relied on it in good faith. And if disputes arise over a transfer or transmission, say, the company refuses to register it, or there's a claim from someone else, appeals can be made to the Specialized Corporate Law Tribunal, the NCLT, for resolution. And this brings up that important legal distinction between transmission versus transfer. A transfer, as we've discussed, is a voluntary act someone actively decides to sell or give their shares. Transmission, on the other hand, occurs by operation of law. It's automatic due to certain events. The most common examples are the death of a shareholder, where the shares pass to their legal heirs, or the shareholder's insolvency or bankruptcy, where the shares vest in an official assembly. For transmission, crucially, no formal instrument of transfer, no transfer deed, is needed. The legal heirs, for instance, acquire the rights to the shares upon proving their claim, like with a will or succession certificate, but they don't automatically become registered members. They need to apply to the company to have the shares registered in their names. Understanding this distinction is vital for how ownership legally changes hands in these different circumstances.
Financing operations, borrowing, charges, and dividends.
Okay, we've covered companies raising capital through issuing shares, but that's often not enough. Companies also need to borrow money, take out loans to fuel their growth, fund projects, manage cash flow. What are the rules around corporate borrowing?
Companies definitely need borrowing powers. It's essential for business. The board of directors typically has the authority to exercise these borrowing powers on behalf of the company. However, there are significant limits imposed by law to protect the company and its shareholders. Under the Companies Act, there's a key threshold. If the money a company intends to borrow, when added to the money it has already borrowed and has outstanding, if that total proposed debt exceeds the aggregate of its paid-up share capital, its free reserves, and its securities premium account, then that additional borrowing requires a special resolution from the shareholders.
Special resolution. That means a 75% majority vote is needed.
Right, exactly. A 3/4 majority of members voting at a general meeting must approve it. This provision acts as a really vital check, ensuring shareholders have a significant say in major debt decisions that could fundamentally alter the company's financial risk profile and stability. It's also important here to distinguish between borrowing that is ultra vires, the company meaning beyond the company's fundamental powers as laid out in its MOA, which would make the loan totally void, and borrowing that is intra vires, within the company's general power to borrow, but perhaps goes beyond the director's specific authority limit, as set maybe by the articles or that shareholder resolution we just discussed. In that latter case, where the directors exceeded their authority but the company could borrow that much, the company might still be held liable to repay the loan if the lender acted in good faith, without knowing about the internal limit breach, or if the transaction was later ratified or approved after the fact by the shareholders. It becomes more about internal procedure versus fundamental power.
Okay, that makes sense. So besides just getting regular bank loans, what are some common instruments companies use when they want to raise long-term debt?
A key instrument companies use for raising long-term debt finance is issuing debentures, or sometimes bonds. There are quite similar concepts. These are essentially written instruments, formal documents, issued by the company that acknowledge a debt. They typically contain a promise to repay the principal amount at a future date, and usually to pay regular interest payments in the meantime. Think of them as more formal, often tradable IOUs from the company to the investors who lend the money.
And I assume these debentures come in different varieties too, just like shares.
They certainly do. There's quite a range. You can have non-convertible debentures, NCDs, which are pure debt instruments. You lend the money, you get interest, and you get the principal back at maturity. Simple. Or they could be partly convertible debentures, PCDs, fully convertible debentures, FCDs, or even optionally convertible debentures, OCDs. These give the holder the right, or sometimes the obligation, to convert the debt into equity shares of the company later on, under specific terms and conditions. Debentures can also be secured, meaning they are backed by a charge over specific company assets, giving the holders priority if things go wrong, or they can be unsecured. And in terms of repayment, they're usually redeemable, meaning they have a fixed maturity date when the principal must be repaid. Historically, companies could issue irredeemable or perpetual debentures, ones with no fixed repayment date. But here's a really surprising and crucial fact of the current Companies Act of 2013 in India. Companies are now prohibited from issuing perpetual or irredeemable debentures. All debentures issued now must have a specific redemption date, ensuring investors know when they should expect their principal back.
That's a significant change, clearly aimed at protecting investors from being locked in forever. And speaking of protection, how does the law ensure companies actually put aside the money needed to pay back these debentures when they mature?
That's a very important consideration, and the law addresses it through the concept of a debenture redemption reserve, DRR. To safeguard the interest of debenture holders, particularly for public issues of debentures, the law requires companies meeting certain criteria to create this reserve. It's essentially about earmarking a portion of the company's distributable profits each year, specifically for the purpose of redeeming the debentures.
So it's like a mandatory savings account funded from profits, specifically for debenture repayment.
Exactly. It's a great analogy. This ensures that funds are gradually accumulated and retained within the company for repayment. It also implicitly reduces the amount available for dividend payouts, thereby minimizing the risk that the company might face a default due to profitability issues or a lack of liquidity when a large debenture issue matures. Furthermore, companies are also required to invest or deposit a certain percentage, currently at least 15% of the amount of debentures maturing in the upcoming financial year. This sum must be placed in specified investments, like scheduled bank deposits or government securities, by a certain date each year, usually April 30th. This provides an additional layer of liquid security for debenture holders, ensuring readily available funds are earmarked for the imminent repayment. And for larger public issues of debentures, there's another layer of protection: the appointment of a debenture trustee. This is a crucial role, usually filled by a bank or financial institution, and formalized through a legal document called a debenture trust deed. The debenture trustee acts as a kind of watchdog, representing the collective interests of all the debenture holders for that particular issue. Their duties include ensuring the company creates the proper security, the charge on assets, if the debentures are secured, monitoring the company's compliance with all the terms and conditions of the debenture issue and the trust deed. And they even have the power, in some cases, to appoint a nominee director to the company's board if the company defaults on paying interest or repaying the principal. They really act as a direct representative and safeguard for the debenture holders, especially if the company runs into financial difficulties.
That sounds like a really important role, ensuring the company keeps its promises to its lenders. And to make sure those promises are backed by something concrete, companies often create what are called charges on their assets when they borrow. What exactly is a charge?
A charge, in this context, is essentially a right created by a company over its assets or property, or any of its undertakings, as security for getting financial assistance, like a loan or debentures. Common forms include mortgages, which usually involve specific immovable property, and liens or hypothecation, often used for movable assets. Think of it as putting a legal claim or encumbrance on specific company property.
So if the company defaults on the loan, the lender who holds the charge can potentially go after those specific assets to recover their money.
Precisely. That's the core purpose of security. Key features of a charge are: it's a right over the property, but it's not usually a transfer of ownership. The company still owns and typically uses the asset. Crucially, for a charge to be legally effective against other creditors or a liquidator, it must be registered with the Registrar of Companies. This makes the charge public knowledge. Charges can be broadly categorized into two types. A fixed charge is created on specific, identifiable, usually long-term assets, like a piece of land, a building, or a particular piece of heavy machinery. The company usually can't dispose of this asset without the charge holder's permission, or it can be a floating charge. This is more flexible. It's created over a class of assets that naturally fluctuate or change in the ordinary course of business. Things like inventory, raw materials, or accounts receivable, money owed by customers.
A floating charge sounds a bit, well, floaty. How does that work in practice if the assets are constantly changing?
The fascinating aspect of a floating charge is exactly that, flexibility. Imagine it like a net cast over a constantly changing pool of assets. As the company buys and sells inventory, collects receivables, uses raw materials, the charge floats over whatever assets fall within that defined class at any given time. However, upon the occurrence of certain specified events, typically a default on the loan, or the company going into liquidation, or appointing a receiver, that net suddenly tightens and becomes fixed. This is called crystallization. At the moment of crystallization, the floating charge converts into a fixed charge on the specific assets belonging to that class that exist at that precise moment. This gives the charge holder priority over those assets against subsequent unsecured creditors. This transformation is a critical mechanism for the security holder. And as I mentioned, perhaps the most important practical aspect of any charge, fixed or floating, is its registration. It is the company's legal duty to register the particulars of any charge it creates with the Registrar of Companies, ROC. This ensures public transparency. Anyone considering lending to the company or investing in it can search the public register and see if its assets are already pledged as security. Non-registration has very severe consequences for the lender, the charge holder. An unregistered charge becomes void, completely ineffective against the liquidator if the company winds up, and also against any other creditor of the company. The Anti-Friction Bearing Corporation Limited v. State of Maharashtra case really emphasized this absolute legal requirement for registration, highlighting that non-compliance means the security is essentially lost in an insolvency scenario. There are strict time limits for registration, typically within 30 days of the charge being created, although this can be extended up to 300 days in total if you pay additional fees and provide sufficient reason. Failure to register within the deadlines can lead to serious legal impediments for the lender trying to enforce their security, and it also creates incorrect public records, which can mislead others dealing with the company.
Wow, okay. So registration is absolutely critical for the lender to actually be secured. Now, besides issuing shares and debentures and taking loans secured by charges, can companies simply accept deposits from people, maybe like a bank does? I imagine that's gotta be heavily regulated too.
You're absolutely right. It is very heavily regulated, primarily to protect the savings of the general public. While companies can accept deposits both from the public if they meet eligibility criteria or from their own members, the term deposit itself is very carefully defined. Not all money received by a company counts as a deposit under the Companies Act. Certain amounts are specifically excluded from the definition. These include things like loans received from banks or other financial institutions, intercompany loans, loans between two companies, security deposits from employees, or money received as genuine share application money. Unless that share application money isn't actually used to allot shares within 60 days of receipt, and it isn't refunded within the next 15 days after that. If it's held beyond that time frame, then it gets treated as a deposit.
Okay, so the law is trying to distinguish genuine business receipts and borrowings from what could be seen as the company taking public funds without proper safeguards.
Exactly. It's about preventing companies from acting like unregulated banks. There are strict rules on the period for which deposits can be accepted. Generally, it has to be between 6 months and 36 months. No very short-term or very long-term deposits usually allowed. And there are limits on the total amount of deposits a company can accept, usually linked to a percentage of its net worth, paid-up share capital, plus free reserves and securities premium account. For example, eligible public companies might be able to accept deposits from their members up to 10% of their net worth. And similar to the requirement for debentures, companies accepting deposits also need to maintain a deposit repayment reserve account. They must deposit at least 20% of the amount of deposits maturing during the upcoming financial year into this dedicated reserve account by April 30th each year. This is yet another layer of investor protection, ensuring the company earmarks specific funds for repaying depositors when their deposits fall due.
Financial health and accountability accounts, auditors, and reporting.
Okay, so companies are raising money, borrowing money, spending money, hopefully growing. How do we actually know they're doing all this transparently and responsibly? How do we check their financial health? This is where financial accountability comes in, and it surely starts with keeping proper records, the books of account.
Absolutely, that's the bedrock. Every single company, regardless of size or type, is legally mandated to maintain proper books of accounts at its registered office. And these books must give what the law calls a true and fair view of the company's state of affairs, including its financial transactions. This requirement extends to any branches the company might have, whether in India or abroad. And crucially, reflecting modern business, these records are permitted to be kept in electronic form, provided certain safeguards are met. These meticulously maintained books are the absolute foundation for preparing the company's annual financial statements, balance sheet, profit and loss account, etc. And those financial statements, in turn, are used for all the annual return filings with the corporate registry, the ROC.
And what happens if those books are suspected of not being so true and fair? Is there a mechanism for regulators or courts to step in and check, or even force a correction?
Yes, there is. The law provides a mechanism for this. The Hari Sankaran v. Union of India Supreme Court case, for instance, affirmed the power of the tribunal, the NCLT, to order the reopening and recasting of a company's accounts. This power can be exercised if it's found that the accounts were prepared in a fraudulent manner, or if the company's affairs were seriously mismanaged in a way that casts significant doubt on the reliability of those financial statements. This power serves as a crucial backstop, a check on financial integrity, and a potential remedy against corporate fraud or manipulation of accounts.
And on a broader regulatory scale, overseeing the whole system of financial reporting, there's a relatively new authority in India, isn't there? The NFRA.
That's right. The central government established the National Financial Reporting Authority, NFRA, back in 2018. This was a really significant development in corporate governance, as NFRA effectively replaced the older advisory body, the National Advisory Committee on Accounting Standards. NFRA is designed to be a much more powerful, independent regulatory authority focusing specifically on financial reporting and auditing standards. It has wide-ranging powers. It can recommend accounting and auditing standards to the government, monitor and enforce compliance with these standards, oversee the quality of service provided by auditors and audit firms, especially for larger listed companies and certain other classes of entities. And it can even investigate cases of professional misconduct by auditors and impose penalties. Its creation aimed to bring a new level of independent oversight, enhance audit quality, and boost investor confidence in financial reporting.
Okay, so NFRA sets the standards and oversees the auditors.
Yeah.
But who actually checks the books of individual companies day to day, or rather year to year? That's the job of the auditors themselves, right? Often called the company's watchdogs.
Precisely. Auditors play an absolutely critical role in the ecosystem of financial transparency and trust. They are independent professionals, usually chartered accountants, appointed typically by the shareholders at the annual general meeting. The law sets out very specific criteria for who can be appointed as an auditor and also lists clear disqualifications to ensure their independence is maintained. This is paramount. For example, an auditor cannot have certain conflicts of interest, like holding securities or shares in the company they are auditing, or being indebted to the company beyond prescribed small limits. Their independence is fundamental to their ability to provide an unbiased, objective assessment of the financial statements.
In the special case of government companies, I assume the CNAG, the Controller and Auditor General, has a significant role here too.
Indeed, they do. For government companies, the CNG plays a central and unique role in the audit process. The CNAG is responsible for appointing the statutory auditors for these companies. They can also conduct supplementary audits or test audits if they choose, and they direct the manner in which the audit should be conducted. This ensures a specialized level of public accountability for taxpayer funds invested in these companies. Now, for all companies, the auditor's main output is their formal auditor's report, which is addressed to the members' shareholders. This report must state whether, in their opinion, the financial statements give a true and fair view of the company's financial position and performance, and whether they comply with the Companies Act and the relevant accounting standards. Furthermore, for many companies, there's an additional, very detailed reporting requirement known as the Company's Auditor's Report Order, CARO. CARO requires auditors to specifically report on a wide range of operational and financial matters beyond just the main financial figures. This includes checks and comments on things like the maintenance of fixed asset records, physical verification of inventory, loans given by the company, compliance with rules on investments, repayment of statutory dues, and much more. CARO provides much deeper insights into the company's operational health, internal controls, and compliance practices, not just its bottom line financial results.
So it's definitely not just about the numbers adding up. It's about getting a much bigger picture of how the company is actually being run and managed. And beyond these financial audits, some companies, particularly larger ones, also undergo something called a secretarial audit. What does that entail? Is it different?
Yes, the secretarial audit is quite different and fascinating because it moves beyond pure finance. You can think of it as a comprehensive compliance audit. It's conducted by an independent company secretary in practice. Its focus is on checking whether the company has complied with the provisions of a whole host of applicable laws, rules, regulations, guidelines, and standards. Not just the Companies Act, but potentially labor laws, environmental laws, sector-specific regulations, listing requirements, etc. It's like an operational and legal health checkup.
So it's like a broad legal and procedural checkup to make sure they're playing by all the relevant rules, not just the financial ones.
Exactly. It's mandatory for all listed companies and also for larger public companies that meet certain thresholds for paid-up share capital, Rs 50 crore or more, or turnover, Rs 250 crore or more, or outstanding loans borrowings from banks, public financial institutions, Rs 100 crore or more. This audit acts as an effective tool for proactive corporate compliance management. It's designed to detect non-compliance early on before it becomes a major problem. The secretarial auditor issues a formal report, which is attached to the board's report. It helps the board and management understand their overall compliance status across various laws. And importantly, any qualifications, negative observations, or adverse remarks made in the secretarial audit report must be explicitly explained by the board in their own report to the shareholders. This ensures accountability for any compliance shortcomings identified. It's really a proactive governance and risk management tool for the board.
And all this information, the financial statements, the statutory auditor's report, the secretarial audit report, eventually gets compiled into the company's big yearly story, the annual report.
Yes, the annual report is the company's comprehensive formal communication package sent out once a year to its shareholders and other stakeholders. It details the company's activities, performance, financial health, and governance practices over the past financial year. For listed companies, it's an incredibly crucial disclosure document, scrutinized by analysts, investors, and the media. It typically includes key sections like the management discussion and analysis, MD&A, which gives management's perspective on the business environment, performance, risks, and outlook. It contains the audited financial statements, along with the reports from both the statutory auditor and, if applicable, the secretarial auditor. It also provides detailed disclosures on things like loans, guarantees, and investments made by the company, and particulars of contracts or arrangements with related parties.
And I believe it often includes some other interesting non-financial details as well.
Indeed. Depending on the company and regulations, it might disclose details about sweat equity shares issued, employee stock option plans, ESOPs, and sometimes even statistics on employee remuneration, comparing top salaries to the median, for example, and crucially reflecting social responsibilities under the Sexual Harassment of Women at Workplace, Prevention, Prohibition, and Redressal Act, 2013. The annual report must include a statement detailing the number of sexual harassment complaints received during the year and how many were disposed of. This highlights the company's commitment to providing a safe and equitable workplace environment. Copies of the full annual report must be sent to shareholders, placed on the company's website, if it has one, and formally filed with the Registrar of Companies, usually within 30 days of the annual general meeting where it's adopted. And just to note, for one-person companies and small companies, recognizing their smaller scale, there's an option to file a simpler, abridged annual report in Form MGT-7A to ease their compliance burden.
Governance and Action Directors, KMP, and meetings.
We've covered the company's structure, its legal personality, and its financial reporting. Now, let's turn to the people who actually run the show day to day, the directors. They're absolutely central to a company's management and governance, right?
Absolutely central. Directors are the individuals entrusted with the management and strategic direction of the company. They act collectively as the board of directors. The law sets out specific rules for how they are appointed. This covers the first directors whose name during incorporation. Subsequent appointments are usually made by shareholders at the AGM, or sometimes by the board itself to fill casual vacancies, and even, in very rare cases of mismanagement, appointed by the tribunal. Every individual intending to become a director needs to obtain a unique identifier, Director Identification, DIN, before they can be appointed. There are also clear disqualifications laid out in the Act, Section 164. People might be disqualified if they are of unsound mind, undischarged insolvents, have been convicted of certain serious offenses and sentenced to imprisonment, or have failed to pay calls on shares they hold. These rules aim to ensure that only fit and proper individuals hold these positions of significant trust and responsibility.
And what if a director is, say, linked to another company that's gotten into serious trouble, maybe failed to file its accounts for years? Does that affect their ability to be a director in other compliant companies?
That's a great practical question, and yes, it can have serious consequences. The office of a director can become vacant under specific circumstances listed in the Act, and one of those circumstances relates to directorships in defaulting companies. The G. Vasudevan v. Union of India case you mentioned, decided by the Madras High Court, upheld a provision in the Act, Section 164B with 167. This provision basically says that if a director is, or has been, a director of a company which has continuously defaulted on filing its financial statements or annual returns for 3 years, or has defaulted on repaying deposits or debentures or paying dividends for 1 year or more, then that individual can become disqualified from being appointed or reappointed as a director in any company for a period of 5 years. And if they are already a director in other companies, they might have to vacate those offices too. This creates powerful incentive for directors to ensure all the companies they are associated with remain compliant, as failure in one can impact their ability to serve on other boards. Furthermore, within the board structure itself, good governance principles, especially for listed companies and larger public companies, emphasize the role of independent directors. These companies are required to have a certain proportion of their board, often at least 1/3, composed of independent directors. These individuals must meet strict criteria for independence, meaning they shouldn't have any significant financial relationship, pecuniary relationship, or familial ties with the company, its promoters, or its senior management, other than receiving director's fees. Their independence is vital. They bring an objective perspective, they can challenge management assumptions, they often chair key committees like the audit committee, and they are seen as guardians of the interests of all shareholders, especially minority shareholders. And crucially, unlike executive directors or promoter directors, independent directors typically do not retire by rotation at AGMs, giving it more stability in their oversight.
And is there a limit to how many directors a single company can actually have on its board? Can it just keep adding more?
Yes, there is a general limit. The Companies Act states that a company can have a maximum of 15 directors on its board. However, a company can appoint more than 15 directors, but only if it first gets approval from its shareholders by passing a special resolution at a general meeting. Interestingly, there are exemptions to this requirement for government companies and also for Section 8 companies, the not-for-profit companies. They can appoint more than 15 directors without needing that special shareholder resolution, perhaps reflecting their unique governance needs or public service objectives.
Okay, so the board of directors provides the oversight. But beyond the board itself, there are other crucial executive roles, often grouped together and called key managerial personnel, KMP. Who typically falls into that category, and why is this designation important?
Right, KMP refers to the core senior management team responsible for the company's day-to-day operations and critical functions, distinct from the non-executive or independent directors on the board. The law specifically defines KMP to typically include roles like the Chief Executive Officer, CEO, or Managing Director, MD, Chief Financial Officer, CFO, the Company Secretary, CS, and any whole-time director. The appointment of individuals to these specific KMP roles is actually mandatory for certain classes of companies, usually larger ones, because these positions are considered so critical for effective management and compliance. Generally, a whole-time KMP, like a full-time CEO or CFO, cannot hold a similar KMP office in more than one company at the same time, although they might be allowed to be a director in a subsidiary company. This rule ensures they dedicate their primary focus to the company appointing them. And if a KMP position becomes vacant for any reason, the board has a legal obligation to fill that vacancy within 6 months.
So these are the top executives really in the trenches, running the company day to day. What happens if things go wrong under their watch? Are they automatically held liable just because of their title?
That's a very important distinction the courts have made. While KMPs hold positions of significant responsibility, they aren't automatically held liable for every wrong committed by the company simply because of their title. The Supreme Court case of Shiv Kumar Jatia v. State of NCT of Delhi provided important clarification here. The court ruled that merely making vague allegations against someone or pointing out they hold the position of managing director or chairman isn't sufficient by itself to attribute criminal intent or liability to them for an offense committed by the company, unless there's evidence of their direct involvement, consent, connivance, or specific negligence, or where a statute explicitly imposes vicarious liability on them due to their position. KMPs are not held liable simply by virtue of their office. This provides a necessary level of protection against frivolous prosecution while still ensuring accountability for their actual actions, omissions, or where the law specifically makes them responsible.
Right, that makes sense. It avoids just blaming the person at the top for everything. Now that brings us naturally to how much these key people, the directors and KMPs, can actually be paid. For public companies, I understand there are specific limits on managerial remuneration.
Yes, there are indeed specific limits, particularly for public companies. The Companies Act imposes an overall ceiling on the total managerial remuneration that can be paid by a public company to all its directors, including MD, WTD, and its manager, if any. This total remuneration in any given financial year is capped at 11% of the company's net profits for that year. The net profits here are calculated in a specific manner prescribed under Section 198 of the Act. This cap is a significant governance measure designed primarily to prevent excessive payouts to top management that could potentially harm shareholder value or be disproportionate to the company's performance.
11% of net profit. But I imagine there must be some flexibility. What if a company wants to pay more, maybe to attract top talent, or if it's having a bad year with low profits?
Yes, there is some flexibility built in. The 11% limit can be exceeded, but only with the prior approval of the shareholders obtained via special resolution passed in a general meeting. However, even with shareholder approval, the remuneration paid, especially in cases of inadequate profits or losses, is subject to the conditions laid out in Schedule V of the Companies Act. This schedule provides detailed guidelines and caps based on the company's effective capital, ensuring fairness even when exceeding the standard profit-linked limit. Furthermore, there's another check. If a company has defaulted on payments of dues to any bank or public financial institution or non-convertible debenture holders or any other secured creditor, it needs to obtain prior approval from those specific creditors before it can even approach the shareholders to seek approval for paying remuneration above the statutory limits or Schedule V limits.
Wow, okay.
This entire framework of remuneration caps and approval requirements applies specifically to public companies. Private companies generally have much more freedom in deciding managerial remuneration. They're not typically subject to these statutory caps, reflecting their closely held nature and different governance dynamics.
Okay. And speaking of specific KMP roles, let's talk a bit more about the company secretary. We mentioned they are often a KMP. What's their unique contribution to the company's governance?
The company secretary, CS, plays an absolutely pivotal, often multifaceted role within a company's governance structure. They're often seen as the conscience keeper of the company, acting as a crucial bridge between the board of directors, the management, the shareholders, and even external regulators.
Their duties are extensive and vital for ensuring compliance and good governance. These typically include providing legal and procedural advice to the board, ensuring the company adheres strictly to the guidelines in its memorandum and articles, conducting the mandatory secretarial audits for applicable companies, and providing essential support to the chairman and the board during meetings. This involves developing meeting agendas, ensuring all governance requirements are met during the meeting, taking accurate minutes, and ensuring compliance with all procedural formalities. Fundamentally, they are responsible for ensuring the entire organization follows all applicable laws, regulations, and corporate governance codes. They need to operate with the highest integrity and independence, truly serving as the company's primary compliance expert and governance professional.
That sounds like a very demanding and crucial role indeed. And all these directors and KMPs, they don't just act individually most of the time. They make collective decisions, especially the board. Informal board meetings. How important are these meetings legally?
Board meetings are absolutely fundamental to corporate decision-making. The board of directors, acting collectively, makes the key strategic and oversight decisions for the company. The law specifically recognizes the importance of collective deliberation by stipulating that certain significant powers can only be exercised by the board through resolutions passed at a properly convened meeting of the board. These powers cannot be exercised simply by passing a resolution by circulation, meaning just sending a document around for signatures without a discussion. These critical powers that mandate a formal meeting include things like making calls to shareholders for the chairman, authorizing the company to buy back its own shares, issuing securities like shares from ventures, monies invested in the company's funds, granting loans or guarantees, approving financial statements, diversifying the business, or approving evaluations or mergers. The need for a meeting underscores the ability to discussion, debate, and collective judgment for these major decisions.
Right, so no shortcuts allowed. What about the basic procedures? Are there strict rules?
Yes, there are quite strict rules governing board meeting procedures to ensure fairness, proper notice, and accurate record keeping. First, there's the quorum requirement, the minimum number of directors who must be present for the meeting to be validly held, and decisions to be binding. The law usually sets this at their lowest total strength, 2 directors, 2 retire. Then, there's the notice. Directors must generally be given at least 7 days clear notice of the board meeting, sent to their registered address. Shorter notice might be permissible only if urgent business requires it, and certain conditions are met. Often, notification by independent directors is present. Minutes of the meeting must be recorded diligently. It should contain a fair and correct summary of the proceedings, including decisions taken and directors present. These minutes must be finalized and signed by the chairman of the meeting, the chairman of the next meeting, within 30 days. They must be preserved permanently as the official record of the board's actions. And reflecting modern times, rules around virtual meetings have evolved significantly. Following an amendment in June 2021, board meetings can now generally be held via video conferencing or audio-visual means for all members, allowing directors to participate remotely, which greatly enhances flexibility and efficiency. Additionally, there are detailed secretarial standards, like SS1 specifically for board meetings, issued by the Institute of Company Secretaries of India, which provide mandatory principles and best practices for conducting board meetings, covering everything from agenda setting to minute keeping, ensuring a high standard of governance.
Okay, that's pretty straightforward. Now let's talk about a potentially tricky area, transactions between the company and its related parties. What's the main concern there, and how does the law try to regulate these deals?
Right. Transactions with related parties are subject to intense scrutiny under company law, and for good reason. A related party typically includes directors, their relatives, key managerial personnel, KMP, their relatives' firms or private companies where a director or manager is a partner or member director, public companies where a director or manager holds significant shareholding or is a director, and holding subsidiary or associate companies. The core concern is the potential for conflicts of interest. There's a risk that these insiders might use their position to orchestrate deals to benefit themselves or their associates, rather than acting in the best interest of the company and of the chairman. So the law steps in to ensure such transactions are fair, transparent, and properly approved. Section 188 of the
transformations and investigations.
Okay, we've covered a huge amount of ground on how companies are set up, financed, governed, and held accountable. Now let's look at how they evolve over time, how they might restructure themselves, and also what happens when things go seriously wrong and investigations are needed. It seems appropriate to start with the ultimate power holders in many ways, the members, exercising their collective voice in general meetings.
Yes, general meetings are the primary forum where the members, shareholders, exercise their collective power and influence. There are two main things. The annual general meeting, AGM, is mandatory and must be held by every company once every calendar year, within specific time frames laid out in the Act, usually within 6 months of the financial year end and not more than 15 months of the AGM. The usual business at an AGM includes considering and adopting the financial statements, declaring dividends, appointing directors, replacing and hiring, and appointing or reappointing auditors. Then you have extraordinary general meetings. These can be called by the board of directors whenever they deem necessary. More importantly, they can also be called by members themselves if they deem so as shareholders, usually holding at least 10% of the share capital. AGMs are called to transact any merger or business like currently in the AGM. This is where shareholders truly hold the ultimate decision-making power on it.
And just like board meetings, I assume there are specific rules and procedures governing how these general meetings must be conducted.
Absolutely. The procedures are quite detailed to ensure fairness and proper participation. Again, notice this. Generally, shareholders must be given at least 21 calendar days notice of the general meeting, specifying the place, date, day, time, and the agenda or business to be transacted. This notice usually needs to be accompanied by an explanatory statement for any special business items. Quorum requirements specify the minimum number of members who must be personally present by proxy, depending on the company type and requirements, for the meeting to be valid. For public companies, the quorum varies based on the total number of members. For example, 5 members personally present if the total number is not more than 1,000. Decisions at general meetings are made by passing resolutions. An ordinary resolution requires a simple majority, more than 50% of the votes cast by members present in person or by proxy. This is used for routine matters like adopting accounts or appointing auditors. A special resolution, required for more significant decisions like altering the memorandum, articles, changing the company name, or reducing share capital, requires a much higher majority of the 75% of the votes cast. The chairman of the meeting plays a crucial role in conducting the proceedings fairly, ensuring order, ascertaining the sense of the meeting on resolutions, and potentially using a casting vote in case of a tie on critical resolutions. And just like the board meetings, technology has significantly impacted how general meetings are held. Virtual meetings conducted entirely online or hybrid meetings allowing physical meetings have become much more common, especially because of the pandemic and particularly for those attending. The law now facilitates listed companies and certain large companies are often required to provide remote voting facilities to their shareholders, allowing them to cast their votes electronically. This has dramatically increased shareholder participation, especially for those newer companies, and reduced the logistical burdens and processes of general meetings. Though typically once a meeting is cast remotely,
Okay, so companies aren't static. They hold meetings, make decisions, but they can also undergo really major transformations, like merging with other companies or undertaking complex restructurings. How does the law handle those kinds of significant corporate changes?
Companies certainly aren't static. They need to adapt and evolve. The law provides frameworks for significant restructuring activities through mechanisms like compromises, arrangements, and amalgamations, which are essentially mergers. A compromise usually involves reaching an agreement with creditors to settle debts, perhaps by paying a reduced amount. An arrangement is a broader term that can cover various reorganizations of the company's share capital, structure, or business. Amalgamation or merger involves 2 or more companies combining into one. These are typically complex processes because they affect the rights of various stakeholders, shareholders, different classes of creditors, employees, etc. Therefore, they generally require the sanction or approval of the tribunal, the National Company Law Tribunal, NCLT, in India, which acts as an independent judicial body overseeing the process.
So the tribunal basically acts as a gatekeeper, ensuring these big deals are fair to everyone involved.
Exactly. The tribunal plays a crucial oversight. Typically, the company proposing the scheme must comply to the NCLT. The NCLT special procedure for certain cases, like mergers between two or more similar companies, or between a holding company and its wholly owned subsidiary. This avoids the need for NCLT approval for specific, less complex scenarios, relying instead on approvals from shareholders, creditors, and regional.
That makes sense for simplifying straightforward cases. Now, what happens if things go wrong internally? Say if majority shareholders or the management starts acting unfairly towards minority shareholders, or just completely mismanages the company's affairs. Does the law offer any recourse for those who feel oppressed or cheated?
This is a really critical area of corporate law, providing protection for minority shareholders against oppression and mismanagement. While the general long-standing legal principle established way back in the English case of Fossey-Yarger law is that the company itself is the proper entity to sue for wrongs committed against it, known as the proper plaintiff rule, meaning individual shareholders usually can't sue for harm done to the company. There are very important statutory exceptions to this rule, specifically carved out for situations involving oppression of members or prejudicial mismanagement of the company's affairs. Affected members, if they meet certain minimum shareholding requirements, usually meaning at least 100 members or members holding 110th of the issued share capital, can apply directly to the tribunal, CMT, under specific sections of the Companies Act, sections 2.
So the law pierces the company is the right plaintiff rule here to protect vulnerable minorities. What kind of remedies can the tribunal actually provide in such cases?
The tribunal has been granted very broad and flexible powers to provide effective remedies in oppression and mismanagement cases. Its primary goal is to put an end to the matters of the NCLT can make a wide variety of orders. These might include regulating the future conduct of the company's affairs, ordering the purchase of shares of the rest minority members by other members or by the company itself restricting the transfer or allotment of shares, setting aside past transactions or appointing directors, or even ordering alterations to the company's memorandum of articles. The powers are really extensive, designed to provide tailored solutions to ensure fairness and potentially salvage the company if possible. It's worth noting a recent Supreme Court application. The dispute fundamentally revolves around inheritance claims to shares by the that ownership dispute must first be established in result of a regular civil court before the claimant can initiate oppression and mismanagement proceedings based on the possession. This ensures the NCLT focuses on corporate conduct issues once membership is already established.
Okay, that procedural point makes sense. Now, sometimes companies are set up for a future project, or maybe they just build an asset like land or intellectual property, but aren't really trading or generating revenue yet. Can a company legally just go into a kind of hibernation mode?
Yes, absolutely. The concept of a dormant company allows for exactly that. A company that is formed perhaps for a future project, or to hold an asset or intellectual property, and which has not had any significant accounting transactions during the last 2 financial years, or hasn't filed its financial statements and annual returns, can apply to the Registrar of Companies, ROC, to
some